Hi there, and welcome to the IBAC Tech Trek Podcast, where we explore the outer reaches of insurance technology. As always, I'm Tom Reid, your host and science officer on this journey. And today I'm pleased to be joined by Whitney Benson and Brandon White, the two co-founders of CaptiveSimple. How's it going?
Oh, very good, Tom. Thanks for having us.
Yeah, thank you, Tom.
So we are going to talk about captives today, captive insurance, not the hostage variety, the insurance variety. And we have two folks here who know a ton about it. And I have to admit, until talking to them in our sort of setup conversation, I knew very little about captives. So I'm going to play the newbie here, talking to the experts. So we're going to start with a bit of sort of a elevator pitch here. What is a captive, and why would a large, let's say, 2 million premium client want to have a captive?
So, a captive is a licensed insurance company that is owned and controlled by the insured to self-insure their risks. It's pretty straightforward in that sense. Some of the reasons why an insured might want to start their own captive is because the insurance programs are created and tailored to them, to the client, to the prospect. The premiums reflect their business, their risk, their loss ratio. Claims are handled in a way that best serves those clients as well. So they're not dictated by how the insurance company would like the claim to be handled. The insured has some control in that aspect as well. And the big one here that everybody likes to talk about and really that gets everybody's attention is that in captives, whatever premium is not used within the loss fund can be returned to the client. So up to, 50 to 60% of the premium can be returned to the client.
You mentioned self-insurance, and I was going to ask about that. Like, really, can you talk about what the real difference between a captive setup and self-insurance is? On top of that, what is some of the myths that you might like to bust about captives?
Sure. Well, I said it right off the hop that Captive is a licensed insurance company. And I like to emphasize licensed because there are a lot of myths around captives that, people are just putting money into a savings account to evade taxes, or they're putting their money in the Cayman Islands to evade taxes. There's a lot of exaggeration that goes on in that regard. So it is a licensed insurance company, and that is what differentiates it from self-insurance. Self-insurance is where a client will take money and put it into a savings account. They're self-insuring. When you create a captive, not only are you paying premiums into that captive insurance company, but there's also layers of reinsurance as well. So in the event that there is a catastrophic loss, there is a reinsurance company that will come in and help pay for that loss. So I would say that that's one of the biggest difference between self-insure and captive insurance. Brandon, have you got anything to add to that?
The only other thing that I may add is just the difference between self-insurance and a captive insurance company. Typically both, from a regulatory perspective, both of them are looked at and probably need to be approved by the local regulator. But captives take a more transparent role in that. They also give you access. You're able to access the reinsurance market, whereas traditional self-insurance, you're unable to do so. You're just kind of taking that chance.
That would be a pretty big difference if you're insuring something of high value and you have essentially no cap on the potential losses, right? Which obviously the reinsurance is playing in the on the captive side. Have you ever had, speaking of tax evasion, have you ever had somebody come to you and try to find a way to use your platform to evade taxes? Or can you disclose that?
Jump in, not using our platform, but Whitney and I have both been in the captive industry for quite a long time, and there are plenty of people who will call, and it's good that there's good, solid regulation in place, because I mean, there's a lot of people that will, if they can, they'll try to bend the rules every way they can to get something done, and so it's really good. There's really firm regulatory oversight into those things. But we definitely have had people call that just right off the bat seem like it's kind of a shady conversation. And we just say, hey, look, this has to be actuarially supported. It has to be legitimate insurance. And so That's the good news.
Okay. All right. I'm glad to hear you guys have a check in play to make sure that you don't end up with a lot of shady kind of customers. Glad to
Well,
hear that.
and it's not just us, Tom. It's the domiciles, right? So everywhere that a captive could be domiciled, whether we're looking here in Canada, so Alberta or BC, anywhere in the US, or even offshore in the Cayman Islands, in Barbados, the Bahamas, there are heavy regulations. Those regulators are going through the books, they're looking at the business, the past, the present, the future. There really is no way for a captive insurance company um, to act in that shady sense in the long run. So,
Yeah. And Tom, I was just going to add, it's one of the challenges. Anybody who's listening that is, this podcast is all about tech, and I will tell you, it's one of the things I wasn't expecting is how hard we had to think through how not to be beat if we're trying to automate everything. Automation comes with that risk, right? Of, if the more we automate, the more there's going to be players that could potentially come in. And we had to think through that a lot deeper than I expected coming into this. So what you just hit on is kind of a learning experience for us as well. For me, I'll say, just thinking through, okay, how could this be cheated? We have to make sure it adheres to all those rules and regs that Whitney was just talking about.
So let's change gears here for a second. I do understand that setting up a captive typically takes a fair amount of time, a lot of paperwork, a lot of sweat, and you guys purport to cut through a lot of that. So maybe describe the traditional way of setting up a captive, and then talk about how CaptiveSimple cuts through that, and maybe what parts are still need to be done, by humans, even through your process.
so traditionally, to set up a captive, I was at a very notoriously famous captive conference last year, and I will leave it at that so that I don't point fingers at anybody specifically. But it was outlined that traditionally, to move a captive through a feasibility study, so not even getting the captive up and running, just to move it through to a feasibility study. So to determine if it's a feasible option, what the business is going to look like, what the captive is going to look like. Traditionally, it will take 22 months and it will cost at minimum $75,000 US. Generally, it is more than that, especially for the more complex risks or for the bigger programs. But $75,000 US, that is a huge investment in time. That is a huge investment in money. And myself, when I started looking into captives and how I could use them in my past life as a broker, I found that as a broker, I was kind of getting pushed to the side in this process. There wasn't a lot of education for brokers, for myself, to learn how to talk to my clients about captives, to have a better understanding of what captives were. What I needed to do was find a captive consultant to come in and to have those conversations with my client, which is where Brandon came in. Brandon is a captive consultant. Now, I'm not going to say that Brandon took my business, because he didn't. He was one of the very few captive consultants that helped train myself and some of my other brokers at my previous brokerage. But therein lies this problem where you find a captive consultant, and traditionally that captive consultant will take over working with that client, figuring out what that captive is going to look like and moving them through that process, getting a captive manager, looking at front and reinsurance and this type of thing. And not only that, throughout this captive process, we are sending emails back and forth to captive consultants, captive managers. There's so many people, there's so many players involved in getting a captive up and running. And all of this information is being relayed through Excel spreadsheets and by email. It was like playing button, who's got the button of the latest Excel spreadsheet and the most up to date. And oh no, we fixed, cell A275, but it messed up. And on which part of the spreadsheet? It was chaos. So there was no education. It wasn't automated in any way, shape, or form. And we thought, this is a problem. This is taking too long. And that's why we built CaptiveSimple. One of the pillars of CaptiveSimple is education. We have a captive university. We have over 40 videos within our captive university, and they are there to help educate brokers, prospects, accountants, lawyers, anybody and everybody involved in the captive process on what captives are, how they work, who they're best suited for. We also offer live training. One of the other pillars was the automation part. So we walk a client, whether it's a broker or again, a captive prospect, from indication through viability all the way through feasibility. It's a step-by-step process, and it is very clearly outlined. And by providing that education and that automation online in one place where everybody can access it, we reduced the timeline to feasibility from 22 months down to 3 months, and the cost of $75,000 down to $22,500.
I love the goalpost that Whitney put up there at the 22 months. I was sitting next to her when she heard that, and I also heard the audible response that she gave when that was said in the middle of a large conference. So it was great. But that goalpost of 22 months, if you have the information, our system can do it in as little as 30 days. I know Whitney said the 90 days, but those are the two goalposts I think about, right? Almost 2 years potentially. Even if it's done quickly, a year to 30 days potentially. So those are the things I think about.
As a broker, when you propose a captive to a client and they say, oh, wow, this is a great idea. And you say, awesome, 3 renewals from now, we'll have this in place. It's like, I just can't imagine having that conversation and saying to somebody, yeah, this is going to take, 2 years, at least 2 years. I just don't understand how people say that's okay.
Well, and it can take 2 years. And what's going to happen in those 2 years? Is that traditional carrier still going to cover that risk? Are they going to increase the premium so much that you're going to lose that client? That's a problem, right? And captives are a solution for brokers to use in order to open up their capacity to these ideal clients that they have so that they're not losing them to, oh, well, so and so traditional carrier decided that they're not covering this risk anymore, or I don't have an alternative to a 5% rate increase. How am I going to hang on to this client? These ideal commercial clients, we all know, hold 80% in some instances of our book of business, right? So we need to find, and that's why as I say, when I was a broker, that's why we looked at captives, because we were tired of losing our ideal clients to instances that were beyond our control. And that's why we went to captives, because not only do captives give the client control over their premiums and their claims, it gives the broker control over maintaining that client, right? Because the premiums reflect that client and because the claims are handled in a way that best serves that client, it gives the broker more control over maintaining that client as well.
Yeah. Well, I have a few more questions for you here, but I just have to say, I like technology implementations where they're solving a real business problem, right? Technology for the sake of technology, yeah, it's kind of cool, sometimes, but at the end of the day, it's technology is a support function that's supposed to support the business. And, the business of a brokerage is to, make sure their clients are properly looked after, correct coverage, correct pricing, good service, et cetera, et cetera. And the technology is there to support that, not to do something that's not that relevant.
Yes, CaptiveSimple was not built to take those clients from brokers. We're there to support that broker, to educate that broker, to make them the expert in the room so that they can continue to maintain that client and still charge a commission on the captive. That is very important to us.
Let's talk about a brokerage who's doing a captive for the first time. So they've got no captive experience. What's the profile of a realistic client to start offering this solution to them?
Yeah, absolutely. So, I've seen a lot of literature floating around Alberta that claims that the ideal clients for captives are oil and gas. Now, obviously, oil and gas does fit into a captive, but, you know, Brandon has been working in captives for over 20 years. He's placed over 400 captives. Correct me if I'm wrong, Brandon. But what we know from that is that there is no one specific industry that is best suited to a captive. It really comes down to ideal risks and premium. And an ideal risk to us in the captive industry is loss ratios that are less than, 40%, ideally less than 20%, because again, that client is expecting to see a return on investment. They want to get some of that premium back, right? So the lowest loss ratio as possible, excellent safety programs, long-term strategies, both operational and strategic risk-wise. They need to have a foundation that shows that this business has performed in an excellent way and how they plan to grow into the future. Because captives are expensive to get into. They're a large investment up front, and it takes a few years to start seeing that return on investment. And so it is a long-term play. This is not a short-term solution, it's a long-term play. So a business that has 10, 15, 20 years in the future looking at that. As far as the premium is concerned, we like to say that for a captive, a small to medium enterprise that's looking to get into a group captive, a minimum premium of $250,000 or more is kind of the sweet spot. Now, if you have a client that has $150,000 in premium and has a very, very low loss ratio, they have hardly any losses at all, there can be a market for that. But again, the losses have to be next to nothing. And that's why we say $250,000. In that region, we're looking at some auto liabilities as well. So it's more realistic as far as premiums versus losses. If we're looking at a single parent captive, so where one company creates their own insurance company to self-insure their own risks, it's linear. I like to say, or we like to say, that a minimum premium of $1 million is that benchmark to hit.
Let me bring some clarity to that, Tom, if it's okay, because I love how Whitney just framed that. And if I'm going back to your original question, if I'm sitting there, if I'm a broker, I'm looking at my book of business, a rule of thumb that we actually like to share with folks is think about a 60-40 breakdown. So Whitney just gave you some premium parameters, right? In the premium that's paid in, for every dollar that's paid in, about 40% of that dollar is going to go to expenses to run the insurance company, to run the captive. About 60% is going to be for the payment of claims. So Whitney said earlier, a good loss ratio, that 40-20% mark. Well, hopefully this is telling your audience why. So if I'm spending $1 million or I'm spending $200,000, that you're going to have if you're spending $200,000, you're going to have $120,000 sitting there for the payment of claims. If you look back in the last 5 years of that particular account and you say, well, they've averaged $20,000 a year in claims, Tom, that account probably makes sense to explore, right? Or at least start educating them to look at this. Same thing if it's $1 million. Doesn't matter if it's $1 million and they've got $600,000 sitting there for the payment of claims, and you look back at their 5-year historical, and it's $700,000 on average per year. It doesn't make sense, right? So size may make some sense, but it's all about that 60-40 breakdown, and that's part of that education. So if I'm a broker and I'm sitting there, I'm thinking, okay, I'm going to look at my top 10 accounts, right? Top 10 or 15 accounts, and say, all right, which one of these meet that criteria? And I would start educating those buyers that, look, this is out there. So as my competitor doesn't come in and talk to you about it, I'm just going to come in and educate you and let you know that it's there. And those brokers can use CaptiveSimple if they choose, in front of the client or behind the scenes, to learn it. But it's all about them and helping them understand that. But that 60-40 rule hopefully is just kind of a good rule of thumb for everybody to keep in mind.
Yeah. So I've worked for a couple of insurers over time, and typically a 60% loss ratio is, it's a good loss ratio. The insurance company's making money on that. In your scenario, they're basically flat. Just out of interest, if CaptiveSimple is helping brokers take the cream of the loss ratio crop out of the traditional insurance market and into the captive market, what's that going to do to premiums for the rest of the commercial industry who are not in captives, right? I'm going to answer that question. Obviously, it's going to go up. Have you guys ever run into that situation where you're looking at going, hey, if we're super successful, all the best clean from a loss ratio perspective risks will is you know go to the captive market? That there's implications there, right?
There's certainly adverse selection there, Tom. Adverse selection will apply. Now, the reality is when you think about captives, there's so few people out there talking about this concept that I don't believe there's a true risk. I mean, I think globally there's 3,000 people that call themselves experts in captives, which is crazy to me. But I don't think I, I think there's so few people talking about it that there's probably not as big of a risk. But yes, I mean, I think to your point, if the largest, best risks leave the industry, adverse selection will remain. There's countless examples of it.
So that's a message to all the traditional insurers is they need to do better.
Yeah, like that's healthy competition, right? Hopefully, if they see those large accounts leaving, they do more and become better to better serve those clients, and I think that makes us all better.
Absolutely. Absolutely. Okay, so let's talk about the broker side here. Broker economics. Are we new revenue stream, retention? Where are the benefits to the brokerage? And from the moment that they go onto the CaptiveSimple website to actually having their clients captive set up, how long before that whatever that revenue stream is starts showing up on their P&L?
Well, captive retention is 99%. They're very sticky. So if a broker takes the time, educates themselves, and starts moving their client down that captive path, and they have a captive that is placed within that brokerage, the likelihood of them holding that client is at 99%. I don't think that you can find a retention rate higher than that in any other traditional way. So again, that broker is no longer at the behest of the traditional carriers increasing rates, determining that they're no longer going to cover that risk. And so that retention rate is huge. As I said, though, the broker does need to walk down the path of educating themselves on what a captive is and helping their client run a captive insurance company, run an insurance company, right? Their client is likely not an expert in insurance, but the broker is. And so it does shift the role of the commercial producer or the commercial broker from a policy seller to a strategic risk advisor. And that does require more work on that broker's side. With that said, because there is an additional amount of work that's happening, we believe that it is within right, and we have seen it. We do see it within our industry where agents and brokers still continue to charge their client the same 10, 12.5, 15% and still retain that commission. The difference is that's a 99% retained commission. Again, I bring it back to that. That is huge. That is solving a massive problem when, yes, we are in a soft market, and that is helpful to the commercial industry right now. But as we all know, and we've all seen, or I've seen in my last 20 years, a soft market is not going to last forever, and we will hit a hard market again. And so if we have our clients, our ideal clients, right, with sitting within that captive and that sitting at a 99% retention rate, our revenue stream also is sitting at a 99% retention rate. If we're pulling that business out of the traditional book, it does mean that We might have to hire some junior commercial brokers to come in and to produce and to build up that traditional book again with clients that may not be suited to a captive now. But since we now have a captive expert within our brokerage, we can start training the next generation on what captives are and how to help your client grow their business in a way, in a purposeful way that will help them have a captive in the future as well.
One of the areas of pushback that we get from brokers, and this is a relevant and worthwhile discussion point. Everything Whitney said around the commissions and the fees that you can charge, we stand united in that. The challenge is now it's transparent. So part of the pushback we get is, remember, the beauty of the captive is that it's completely transparent. You have control over claims, as we talked about earlier, right? Over the direction of that insurance company. Well, every dollar is laid out transparently. And so if you're a brokerage that is not doing much for that client, and they're letting the captive manager or some of the service provider, the vendors of the captive that make up that 40% expense load I mentioned earlier, if you're letting them do all the work and you're not taking that strategic seat, that can be a question that's brought up. Maybe then you do make a little less than what you make right now in the traditional market. And so that's important to understand. That's a constant discussion that we're having, because so many in our industry are able to sit back and kind of collect a check each year, right? So you think about that and you say, man, that's a piece of pushback we get in times. I also want to answer a part of your question, as you said, what can the broker expect as they come involved inside of CaptiveSimple early? Well, in the beginning, it's education, right? There's no cost for that. It's not a part of it. But as Whitney stated earlier, there is a cost as you go through indication, viability, feasibility. Indications are free. As you're going through your book of business and you want to look at your top 10, 15 accounts, there's no cost for that. You can look at all those, do as many of these indication studies as you want. You'll need some information, but creating an account's free, all that. Well, viability, as you continue to go through, if it continues to make more sense, viability, we charge $2,500 for. Well, that's an expense. Now, most people will charge their client for that. Remember what Whitney said earlier, a feasibility study can cost $75,000 US if you're going to other folks. Well, as a brokerage, we see many of them charge a little bit more because you're going to have to work here too, right? So maybe they'll charge $5,000, pay $2,500 to CaptiveSimple. The work is done on that side, on the captive side. The second piece, if it continues to make sense for them as a business, well, then it's $20,000 to do the feasibility study. Same principle applies. If I'm the broker, I've got a lot of work that's gone into that. So I'm going to charge a little bit more than the 20 to make sure that that I'm being compensated for my time. So, and then it's the formation of the captive, the retention that Whitney talked about, absolutely correct. So I just wanted to give maybe some more color to what it looks like in the beginning, the fees and things that they can charge before it's part of a bound account that can now start earning commission.
One of the things that I failed to mention as well, that we do see in the captive industry of ways that brokers or agents also have an alternative revenue stream, is some of them do sit on the board of directors of those captives. Each captive requires a board of directors. People have to have, a broker could have a seat on a board of directors too. And that would be a way to have an alternative revenue stream within the captive industry as well.
Brandon, you mentioned that there's work, there's engagement, there's the advice and effort. As a broker, you can't just sit back. Well, I mean, I think that should be the case anyway, whether it's a captive or not a captive, right? I think that if you're dealing with a large commercial account, whether you look at the lawyers and the accountants that these firms engage, they're professionals, they're respected, they put the effort in, and a good broker is the insurance guy who's playing this this similar professional role that some of these other professionals are playing. And I guess if I hear you correctly, what you're saying is if you're not willing to do that, if you don't have a track record of doing it, then maybe going down the captive route is not for you.
Yeah, it's going to shine light on it. So it does put you in that role. And if you're ready for it, terrific. If not, I think that's wise counsel, Tom.
Well, and I think the important thing to point out here is that if you aren't willing to put in that time and to be that person, the wolves are at the door. I had a gentleman come up to me at the Insurance Brokers Association at the convention in Banff here in May. And I was talking about captives and how, as brokers, we need to get out there and start having these conversations with our clients. As Brandon said, maybe your top 10 clients aren't ready for a captive today, but you need to start that conversation now to get ahead of the people who are coming in to speak to clients. This gentleman came up to me and he said, Whitney, I feel like you were speaking right to me. My client, I've had this company for 7 years. I thought we were in a great place. They just came to me and said, so and so came and they've been talking to me about a captive. How come you didn't say anything to me about this? How come you didn't bring this option to me? And this broker, I feel for him because he didn't know. He had heard about captives in passing, as most brokers have. If you're going through an AIC course, a CADE course, whatever course it is you're going through, you might hear about captives in passing, but we haven't spent enough time educating our brokers to give them the opportunity to hang on to these clients. I looked at if we're talking about economics, I looked at the numbers, the commercial premium numbers, and I took them from 2022. And I talked about this at convention. Looking at the commercial market in 2022, there was $1.2 billion that were available in the addressable market that could have been placed into captives. $1.2 billion. That is a ton of premium that people are coming to capture. Captive managers are coming up from the States and they're coming up from offshore. They're going to start having conversations with clients. Captive consultants are coming up here too. There are a few of them cropping up all over the place. These are the cream of the crop, the top of the market. That's the top 5% of the commercial market. We have to get a handle on this. And we, like I said, built CaptiveSimple for that education piece to help brokers build out this capacity and start retaining their clients.
So, Whitney, that was obviously a very traumatic point for that individual. Let's take that, and I'm going to turn over to Brandon here because I think he has an example of somebody who's actually followed through with CaptiveSimple, and we've got the negative side of, oh no, my clients are under attack, I haven't done anything about it, to somebody who's actually being proactive. And Brandon, can you go ahead and tell us that story?
Sure. Yeah, Tom. And people, I want to be clear. People are forming captives, or on the road to forming captives every day inside of CaptiveSimple. But the example that I will share that is, I think, an overwhelming success is a recent broker that just came on in the last week. Came into the system and is in the exact scenario we just referenced, where he's looking at his book. He's saying, you know what, I'm gonna dive in with this particular client, and entered in all the information to kind of do the forecast, like what it may look like. And you know what? This client is not ready yet. They're on a good path. They've had a good couple of years. But as they went down this road, it was eye-opening for this particular broker and their client, because the broker just had a meeting yesterday. He called me after the meeting and said, I just want to tell you what a powerful tool CaptiveSimple was for me. And I could share the text exchange. But he said, I went in, had this conversation with the client, and we have them on a plan now to get them ready to make a captive an option in the future. Now, Tom, I'm going to step away from that for a second and just ask you the question. Now, is that broker at any risk of losing that account in the next couple of years?
No, obviously not.
No. And so to me, that's a success story. Now, did they form a captive? Did they join a captive? No. But that broker took charge of that particular relationship and sat down with that client and said, look, this is what it would look like. This is why you're not ready to be in a captive yet. But let's create a risk management plan together. Let's align our goals, your goals and my goals, and let's make them one. And let's get you ready for this in the future. So it might be a couple years down the road. But to me, that's a great success story.
The world of insurance is changing because the world of tech is changing. Join us on the journey at ibactech.ca.